Welcome to the educational video for the month of March. Today we're going to dive a bit into market volatility, which everybody's experiencing right now. But just first, a quick reminder that the tax season for this year ends April 30th. So if you haven't already received your tax slips or RSP contribution receipts, you should be receiving them shortly. And if you're not sure which slips or receipts you're going to receive, there's a link in this video to the written version, and it has a list of different slips and receipt types based on which account that you may have. So take a look at that, and if you still have questions, feel free to give us a call at any time.
Yeah, and recognize too that your tax slips, a lot of them do get mailed to you. So if you haven't checked your mailbox in a couple of weeks, please do that, because T3s, T5, T5008 statements, they do all get mailed to you, and they come at different times. So you may have gotten RSP contribution receipts a couple of weeks ago, but some of the investment slips for non-registered accounts, if you happen to have that account type, are sort of coming in a staggered fashion over these past few weeks, and some may still be in circulation. But like Kevin said, if you have any questions, feel free to reach out to us as to what tax slips you may have or may be missing.
Yeah, so as I mentioned, we're going to talk about market volatility. With everything that's been going on lately, like the Trump tariffs have caused a ton of stock market volatility, a lot of uncertainty throughout not just the markets, but investors themselves. And so we've been getting a lot of calls about it and emails. And so we just wanted to really touch on a lot of what we're hearing and how David and I have been dealing with that with our clients over the past couple of weeks.
Yeah, for sure. I mean, even just last night, I've gotten a few more emails, people asking me to call them today, which of course I'll do, and go over their portfolio. People are anxious. People are fearful. There's obviously a lot of headlines right now. Oh, we could be in a recession already, or a recession's coming for the United States. And this is not the first time we've heard those calls over the past decade, even over the past couple of years. So many experts were calling for a recession to have occurred in 2022 or 2023, and yet one never materialized. And certainly we may get one. I mean, you can never say never. There's always the possibility of a recession forthcoming at any moment in time. The good news, I think, right now is to recognize that the U.S. economy is still showing decent signs of strength. Canada's economy in the fourth quarter actually started to come back a little bit. The Bank of Canada just cut interest rates again today, March 12th. And so there's some reasons to be constructive despite all the concerns around tariffs. And what gives me optimism right now for clients and investors in general is, just as quickly as these tariffs and this trade war materialized and the reaction has materialized from the markets, it could also go away tomorrow. So just recognize that with investing, bad news can come into the market and the market reacts to it immediately. But also recognize the script can be flipped overnight. Like Trump and Carney or Scheinbaum in Mexico, they can all come and make a new agreement at some point in time. Now, I admit that in the short term, that doesn't seem likely based on Trump's stubbornness and his reiteration of Canada becoming the 51st state, which us as Canadians, certainly it angers us. It's evoking a more visceral response from us Canadians who are pissed off about that, frankly. And obviously there's some worry about what the impact could be on both sides of the border if tariffs go through, because most people recognize, tariffs will be a bit inflationary and so on and so forth. But again, my advice to people is just recognize that as bad as things may seem right now, and as much as you may want to react to that to protect yourself, the script can be flipped overnight, or maybe it'll be next month, maybe 2 months from now, that we have to sort of deal with this volatility before the narrative changes and maybe a new trade deal gets hammered out. And if that were to happen, the market will rally very quickly. That's the important thing to remember.
Absolutely. And David touched on a lot of good stuff there. And most importantly that I want to jump in on was that this could be very short term. Even if it lasts a year, in the general grand scheme of things, that's very short term. And a lot of the retired clients that I have, or people just nearing up on retirement, are concerned about is what's happening with my savings. This is all the money I have to retire on, and I'm watching it go down. I need to do something. I need to react. And I do have some clients saying, like, I want out. I can't deal with the stress. I want to go to cash. And that's a very easy decision to make, to just eliminate that stress tomorrow. Let's go to cash, and I can stop worrying about everything that's going on in the world. But it reminds me of a saying when I was a kid, that don't take the easy way out. It's very easy to make that decision to exit. And maybe after you do that, the market drops another 5%. Maybe it doesn't. And if it does, then you kind of solidify in your mind that I made the right decision. I'm going to sit here for a while because I made that right decision. But then the hard decision comes afterwards. When do you get back in? What has to change in the news, the economy, in the markets to cause you to get off the sideline and back in the game of investing? And that is a near impossible decision to make. I'm going to turn your attention to a slide on the screen. This slide shows what happens if you're invested over the past 30 years and you miss one of the best days in the market. It also shows you miss 5, 10, 25. But what this doesn't really highlight in the graph form is that oftentimes that one best day comes after a prolonged downturn in the markets, which we're seeing right now. So choosing to jump out, you could miss that one day, in which case, looking at the chart on your screen, you can see what happens if you just miss that one day. It's also good to keep in mind that the market is forward thinking, usually about 8 to 12 months ahead of the economy. So the market is already pricing in things that it thinks is happening and going to happen, and it's already looking past it. So while you're waiting for that perfect sign to get back in, you may miss that one really good recovery day. And that's why I've been telling my clients that staying invested is still one of the best strategies that you can have. You're not selling your entire portfolio tomorrow. If you are retired, you're going to be taking that money out in smaller increments. So it's not something you need to concern yourself with your entire portfolio. Possibly maybe just smaller adjustments need to be made.
Yeah, exactly. And I think that there's you have to remember, that's a great point, Kevin, that if you're retired and you have $1 million investment portfolio, and the value has come down by 20 or 30 grand in the last few weeks based on the negative market performance recently. Again, we don't like to see that, neither do you, of course, but recognize that, again, if you're taking a regular monthly income as a retiree, you're not selling that whole $1 million next month or next year for your regular income need. We're selling a small piece of different parts of your portfolio, whether you're a balanced investor who has 60 or 70% of your portfolio in stocks and the other 30 or 40% in a mix of bonds and cash. Well, you may be selling a little bit of those stocks off their most recent peak, but over the last 5 years, that part of your portfolio has made a lot of money. Bonds, on the contrary, haven't done that great in the last 3 or 4 years, but the reason we own those is that in recent weeks, when stocks have been falling, bonds have been holding their value. So diversification, once again, is actually working in this market, which is encouraging to see. Bonds are finally starting to do what we want them to do in a balanced portfolio. They are less correlated to stock markets in recent weeks than they have been in previous years. Certainly in 2022, correlations between bonds and stocks were quite high, and that diversified portfolio wasn't as helpful in 2022 as it has been in recent weeks. The other thing to remember too is that, which is illustrated by this chart on your screen, is that if you could time things perfectly and you could buy at the absolute market low over the past 30 years, you would have had a 9.3% return if you were investing in the TSX, Canadian stocks, over the last 30 years, and you were able to put $1,000 to work at the absolute market low every year. So that would have been great. But in principle, we know that you can't actually, in practice, choose the low every single year. Conversely, if you were to buy at the absolute peak every single year over the last 30 years, your return would have been 8.3%. So that would have been the worst case outcome, buying at the high every single time. But in practice, we know that's also impossible to do. But what is possible to do in practice is to systematically buy investments or systematically sell investments to take an income. And if you were to do that by simply buying at the start of every month or selling at the start of every month, your return would have been 9%, right sort of in the middle there, which is a good outcome for investors. And so at times like these, when there's uncertainty in the market, it is really important to go back to certain investing fundamentals. If you're really worried right now and you're panicking about, how much farther a portfolio value could fall for you, call us. We're here to talk to you about it, and give you the assurances you need that your portfolio is diversified. It is, fairly secure. Ultimately, we can't protect from negative outcomes if you are invested over short periods of time, but that diversification, sticking with the plan, allows you to get to your goals a year from now, 2 years from now, 3 years from now. Also, I've reminded some people, younger investors or investors who may have had money sitting in GICs or cash these last couple of years. Now may be your opportunity to put that money to work for better long-term returns. Sitting in cash in GICs is not actually an investment strategy. Again, with certain portions of your money, holding cash or high interest or GICs can be prudent if you need that money in the short term, for sure. We advocate for that too. But if your portfolio is meant to be providing an income or growing for you over 5, 10, 15 years, you need to stay invested. Or if you're not invested currently, now or next week may be a great opportunity to put some of that cash to work. Again, there's a lot of uncertainty right now in the markets, but we're here to sort of help you through that for sure.
Yeah, and David made a good point there that when people are nervous, even putting some of their portfolio to cash or GICs can make them feel safer. And that's a good thing to remind people that if you look at your statement, for example, you may see a handful of line items from it, but inside each one of those funds is a plethora of stocks. Depending on your portfolio, there could be bonds, GICs, cash already baked into those funds, and you just don't see it because the line item just shows you the fund name. But rest assured, each one of those funds has a fund manager and a team of people that are monitoring and making changes constantly to make sure that fund does what it's intended to do, the reason that we put it in your portfolio, and that it continues to stay relevant depending on what's going on in the market and the economy.
To conclude today's video, we just want to leave you with one last chart to think about. So if you look at your screen, you'll see a chart which shows returns historically for the S&P 500 index, which, as most people know, it tracks the 500 largest companies in the United States. So this goes back to 1980. As you can see by the blue bars, there has been 8 negative calendar year returns for the S&P 500 in the past 44 years. Yet in every single one of these years, whether it ended with a positive return for the index or not, there were corrections along the way. Some of those corrections were pretty significant, and yet the market ended up making a positive return by the end of the year. The most recent example that a lot of people can remember is COVID during 2020. The market crashed over 20% in early 2020, and yet by the end of the year, after fear and pessimism had run its course in the market, the S&P 500 ended up making 18% by the end of that year. And that was a great and most recent example of how investors, if they had panicked in March of 2020 and sold that low, they would have missed out on a massive recovery. And by the time the markets had turned and priced in better news looking forward, those investors who were sitting in cash had to face a very difficult decision. Well, do I put my money back to work when the market's up 15% from when I sold? And that's what we want to try and avoid, making those mistakes in a market like this where there's been a little bit of negativity, and certainly it could get a little bit worse in the short term. We do recognize that. We're not saying that it won't, but things will get better at some point in time. And again, could be next week, could be next month. More than likely, it might be a few months from now. And so we may have to slog through this for a bit longer, but making an emotional reaction, making wholesale changes, taking that easy way out, as Kevin said, and going all to cash is usually, historically has shown, and unfortunately I've seen it in examples in the past with clients, is just not the right decision to make 99% of the time. Again, you can get lucky, you can go to cash for a few months and predict that right, But at some point in time, you have to get back into the markets, which oftentimes is the most difficult things for investors to do.
Absolutely. And we hope that this video has helped minimize some of your stress and concern about what's going on in the market with all the volatility. Like I said earlier, we have been receiving calls and emails, but we know that there's even more of our clients out there that tend to try to wade through these in silence. And that's sometimes the worst thing you can do is sit in your own head or go down the rabbit hole of Google, looking at things, trying to make yourself feel better. Call us. That's what we're here for. Give us a call. We happily go through your portfolio, how it's positioned, how you're already well diversified to deal with the current market volatility. So please, if you need anything, give David or Harry or myself a call.
Thanks. Take care.